Hey everybody, welcome back to Options with Hans. You know the drill. Hans Albrecht, 15 years, pro options market maker, decade as a fund manager, billion in option strategies managed, and I'm here to help you trade smarter with real, repeatable strategies and a process that respects what markets are telling us. If you've been watching any of my stuff, you know that my approach is combining options income strategies with capital appreciation plays, because that is really how you move the needle in the long run. I want great stories. I want great companies, volatility awareness for the right options, the right strategy, of course, given the conditions that we have, process guardrails. So people are blown away by it in the LEAPS program, and I'm happy to be helping folks. Please like and subscribe. Down in the description below, you'll see the free ebooks that you can grab as well. And I'm also going to drop you into my free Intro to Options Cash Flow Blueprint course. It's a 3-day course, and this is for educational purposes only. Your trade, your responsibility, and hopefully you are good with that. If that's the case, let's keep going. And we're going to talk about SOXL, the Inference breakout. Let's meet with a oldie but a goodie, which is our SOXL trade that kind of went viral a few months ago. Everyone was kind of like, wow, this is really kind of cool. We introduced the turbo strategy that kind of used the downside, expensive downside, to finance that upside, which is really one of those pro trades, right? As pros, we're always looking for those areas of the market where there's a little bit of edge, right? What is edge? Well, edge is when you go to the casino, and the casino has all the edge, right? They have the advantage on almost every single bet. There are a couple bets that are pretty close. Pretty close and even in your favor if you play certain bets. But generally speaking, they have the edge, and that's why they have those big, beautiful hotels, and they can give you these wonderful steak dinners and tickets for you to keep playing, which is going to put more money in their pockets over time. Boy, this is where it all started. A few months ago, we started to get excited about that upside, and until then, I've been very, very negative on these kinds of leverage products because they lead to quite a bit of value destruction. You can see SOXL went from something like 70 down to about 8. And so under the wrong conditions, lots of volatility, the wrong direction for the underlying, but lots of volatility back and forth. And we'll talk about that in a moment. So we're going to talk about AI today, which is really incredible. This fast adoption that we are seeing is unlike anything we've ever seen before. We have to understand that this is a completely new paradigm, a new regime, a new everything. Everything changes here, right? So this is occurring at a rate that is probably more than double what we saw with the internet, right? The adoption of the internet. Now, there are certain reasons that, the adoption of computers took a little while, the adoption of the internet took a little while, but it was quite a bit faster than computers, of course. Computers, you got to buy them, you got to get them in the homes, all that physical stuff. Now, AI has this advantage that, well, everyone's got the internet now, and that's basically you're basically programmed to have access to AI. So that, of course, makes it a lot easier than having to go out and buy hardware and things like that. It's everywhere, right? It's in our pocket, it's in our phone. It's quite literally going to be everywhere around us as the inference phase spreads to edge computing and the Internet of Things devices. All the things around us in the world are going to have some sort of insight capability at some point, because it's all about grabbing more data. That's why I'm big on memory. I'm big on storage, things like that as well, which are terrific ways to play the theme, I think. So exponential growth bias. I want to talk about people naturally think in straight lines, right? So why do you talk to some people and they say, well, AI is kind of toppy. It's a little bit toppy here. Now, from a stock market standpoint, I'm sure you understand that things don't always go in a straight line. They don't always go up. They can pull back. We are going to see at some point a terrific 30, 40% pullback in many, many names. We saw that on Palantir. We hit those highs, which we played perfectly in Leaps Trader. We got out basically at the highs that morning, that Wednesday morning. It was quite ridiculous timing, and it pulled back about $40. So what is that? About 20, 25%. These things are going to have these monumental pullbacks. This isn't my first rodeo. I did the late 90s, and I've done other periods of exuberance, and these things can have strong stories, but still pullbacks as well. So we're trying to be aware of that. And trying to play both sides of the game. We've sort of hedging through various things. We've been doing lots of hedging on our hood positions and other kinds of positions where we've got certain hedges on. But this is going to be something special. Psychological resistance, right? Why do people resist this stuff? Well, a lot of people downplay AI's future because it works better for their brains, right? We are thinking creatures. We are emotional creatures. So we don't want to think that there's this incredible disruption upon us right now, which some people are a little bit nervous about. But we're talking about jobs and unrest, and just a general resistance to change. People don't always love change. Early evidence ignored. So inference is already outperforming humans in tasks, right? 148 IQ. This stuff's happening, right? It's starting to get to the point where once the AI is better than we are at something, it starts to be a real game changer. Infrastructure acceleration. So cheaper chips, better models, wider deployment. There's a lot more competition out there. I'll show you in a moment. Valuation blind spots. This is what I think is very interesting, and is I've been calling for this melt up for about 900 points now. And it's partially because of this, because we are human and analysts are still human as well. They sort of think a little bit linearly. They think, well, what's happened in the last 6 months and how can I extrapolate and take that forward to the next 6 months? Well, they price it cautiously. They want to leave, that leaves these potential for upside surprises there, right? And that's why I've been continuing to say that upside is not very expensive. It's not very expensive. The skew isn't very expensive. And that gives us opportunities if you're able to find those. So very exciting time. Look at this. We're scaling way faster than the internet. So I showed this in another video yesterday. OpenAI just kind of scaling hard and faster than Google. Remember, we used to Google? Well, we still Google, but we're going to be GPTing. Do you GPT? I GPT. So don't underestimate what could be happening here in terms of adoption rates. Massive spend. We just saw some confirmation. Cloud forecasts are showing that CapEx is actually accelerating, right? They're scrambling to meet the demand for AI infrastructure. At some point, we may have a problem supply chain wise and input wise for these things. But look at what happened this week. Micron just called out $100 billion memory market, inference workloads again. Remember, inference training is jamming a whole bunch of information into a training model, and it learns. This is where we start to put it to use. Compute is 25, 30 times more intensive than training. It is up to 100 times larger in terms of energy needs. This is a gear that just continues to turn. Around the clock kind of stuff is what we're talking about. That's not slowing. And when Microsoft committed $20 billion to Nebius, which was another name that we've been doing great on, specialized GPU cloud built for inference, right? These GPU clusters being used in smarter storage type facilities is the big thing, right? This is data centers, but smart data centers, not like the kind of Equinixes and some of those other ones that we see. So we are absolutely not plateauing. We are in the early innings of AI's deployment phase, and that means semiconductors, SOXL memories, GPUs, custom silicon is going to be a big thing. I'm going to do another video on custom silicon. Another leg up, right? The compute and data demand is compounding faster than anyone can imagine. And Oracle, Micron, Nebius, we can go on and on. There's just more and more confirmation. I know Oracle's kind of focused on one big company, but we cannot ignore the fact that there's still incredible amounts being spent on this, which is basically the printing press. It is electricity. There's no two ways about it. It's not cyclical. They're going to continue to build out the foundation for AI and AI usage for years to come. And it's very much an arms race. So no one's going to slow down. They have the full support of governments. This is going, and it's going hard. So absolutely no plateauing. Let's take a look at this one other thing here. And this is what I've talked about a few times, which is just basically this idea that the market still has room to go. So when we say inverted call skew, that means that we talked about the turbo. Why it works is that you're selling that expensive skew to basically finance some of the cheaper skew. When this happens, though, the opposite can be the case, right? You see that call skew, basically that upside starts to get really priced in for a great deal of excitement and FOMO. We are nowhere near that point right now. In fact, there's a lot of sentiment indicators that aren't even really very excited at all, which leads me to believe that there's more fuel to the upside in potential. Let's look at some of the sentiment indicators. Goldman Sachs U.S. equity sentiment indicator, really not very excited. People are not getting in. Retail, not that excited. They did play the run up from April, but really not that excited at this point. AAII investor sentiment bull minus bear spread. Look at this coming back down, really not overextended. When we get up to the top here, that is when people are getting a little bit too bulled up, which when that happens, we're going to see this get into this territory of super mania. We're not there yet. There's lots of room for that. That is another reason I'm liking this new SOXL trade and the continuation of the SOXL trade. Length of tasks AIs can do doubling every 7 months. If you don't think this inference phase is something spectacular, you are just not on the right page here. Look at this. They just updated that. They had this article came out a couple months ago, and they updated it after a couple of months, said this is going even faster. Look at the models that we have now. Notice what's happening. It was ChatGPT. Now it's a whole bunch of different models basically pushing the envelope on what's going on out there, what these things are capable of doing. Okay, so let's look at some of the option pricing. Check. Okay, so let's take a look at the SOXL options. We can see right here on our dashboard that we've got a very low IV percentile, low IV rank. We've seen some option pricing start to firm up a little bit across the board. I've been talking about it's just been a little bit too cheap. We see Amazon pushing up. Well, what happens when things start to melt up a little bit, volatility starts to say, whoa, hold on a sec, I don't know what's going on here. I don't know where the top is. And it starts to reflect that in the upside. So when the S&P was around 5,600, 5,700, I said, these upside calls are just too cheap. And I still think they're too cheap. But that led to an incredible opportunity to play that upside, which we've been doing in the programs and leaps, et cetera. Playing that upside that is inexpensive, that is set for a normalization, and also very flat skew. So a lot of different ways to win if you can find those options that are really conducive to those really nice convexity benefits, right? Something like the out of the money. So we can see our term structure, pretty wacky term structure here a little bit, kind of looks like a bird. We're not going to worry about that too much. This actually gets a little cheaper as you go along, which I think is really nice for our purposes. And if you take out the historical vol, let's take a look at the rank and percentile. We can see 10 and 12. So really low. I mean, it barely got any lower, 2 and 6, but we're still fairly low. Like I'm not seeing anything really react all that panicky to the upside. So let's take a look at 6-month options. These are at the money, of course. We'll be looking at some out of the monies as well. We can see here, again, 10 and 12, very similar for that 6-month option volatility, really not pricing in what we think could very well be just this melt up, which I've been talking about SOXL since it was 15 and a half or so. So we've doubled that already. And I think the table could be set for a follow through. Let's look at the 1 year, 5 and 8 ranks. So this is not, I wouldn't call this a great stock to sort of be looking at income trades. I know a lot of people love that about these sorts of products, these leverage products. But for me, it's something that you want to take advantage of in terms of that leverage that you get from being long options. So you want to look at a few other things here. We can look at the skew. This is our SOX that the SOXL is based on. So we can see right here that we've been sort of bouncing up off that zero line. And what that means is that typically those puts are going to be a little bit more expensive. So remember way back in June, that's what we talked about as this sort of very nice bonus that you're getting in playing that upside. You're getting that very nice ability to basically sell the expensive and buy the cheap on the long side of things. So let me flip over here to SOXL, which is going to be that product that does have those daily resets. So some of the vol takes that into account. There's going to be strong moves to the upside and then the inevitable pullbacks. It's going to be chop it up a little bit. So sometimes that upside vol can sort of compress a little bit in anticipation of that. But if we think that the move can be strong and panicky and melt-uppy, then that plays to our advantage, because then it's actually cheap for the sake of being cheap and not just because we think that it's going to have a little bit of trouble going up. So I think that's very conducive to the kind of trade that we want to do. So why don't we take a look at that trade right now? So here's the trade. We're going to go to the Jan 2027. So that's Jan 15th of the year 2027. So this is going to give us lots and lots of time, 487 days. We've got time to be right. We've got time to be wrong before we're right. And that's what I really love about these kinds of trades. They're very balanced, very volatility agnostic, very kind of Greek balanced. I mean, it has long delta, don't get me wrong, but in terms of the theta and the vega and all that, you're very nicely balanced. You're not really sticking your neck out there in terms of some of the risks that you often have to face with trading options. That's really the nice thing. You can kind of zoom out and go, okay, I've got an idea. I think it's going to play out over time, and I'm going to look at this a little bit more with a little longer term view in mind. Doesn't mean you can't take profits earlier, but you're going to give yourself the opportunity to be right. So that's really, really nice. So we're going to look at the 23.17 trade here, 23.18 trade, which is selling that put vertical. We're going to get about 215 for that. We'll have to see where the prices are, but when I looked earlier, 215, and we're going to use that money, right? That's going to give us about a $5 wide spread on that credit trade. So there's a little bit of risk, about 270, 285 in risk in that trade. So on a one lot, you're going to risk about $285 on a one lot to make that 215. But you're going to use that, you're going to finance that upside. So we're going to grab the 35.44, which we're going to get on at 235. So you see what I'm saying here? You're basically spending about 20 cents to put this trade on. That doesn't mean your total risk is 20 cents. Your risk is embedded in this short put spread, this credit bull put spread that you have on, but it enables you to have this kind of wonderful zoom out kind of attitude if you're willing to put that capital at risk, which isn't very much on a one lot. This isn't Netflix or Costco or something like that. This is, you can kind of choose your own adventure here. You want to do one lot, you want to do 10 lot, you want to do 50 lots. It's up to you, according to your risk profile, etc. But this gives you that ability to basically create a nice profile that's going to look really good. And that beautiful sort of skew that we talked about earlier, which is very conducive to this kind of pricing, this structure, is the pro trade part of it that I've talked about. This steepness is really playing in our favor. So we've got this beautiful structure here where you can lose very little if it kind of sits around, but you've got this wonderful upside potential as this melt up continues, as the semiconductor theme continues. And that is really something that I find really powerful. I don't use this all the time. I will use it when I feel like the market really is about to do a lot of the work for me, right? So as an income trader, you want to look at things that way. You want to kind of go, okay, look, there's a time to make income. And so you're going to look at interesting things like MTIs. I've got all sorts of indicators that I like to look at, all sorts of things that will kind of help to keep you on side. But when you kind of feel, and don't battle the market. It'll tell you what it's going to do, right? If you're going sideways, chances are it's going to continue to go sideways for some time. But when it's time to break out, when things are going to go right to the upside and start to gather momentum, that's where you start to remember why you're interested in risk markets to begin with, right? You're not in the market because you want to make a few dollars on income trades forever. You're in it to actually to be able to pivot and do well in various market conditions. Otherwise, you're taking on risk for not a lot of gain, right? So you always want to keep that in mind. And that's really why everything I do and all my programs kind of revolve around this sort of holistic look at, listen, there's a time to go for the little, single base hits, and then there's a time to really go for those triples and home runs, et cetera, et cetera. Hopefully that makes sense to you guys. You can really have a nice run on a 10 lot here. You stand to make sort of 8,800 max, but this could take a little time. It's a longer term trade, right? So this is something that you don't mind if it's a slower burn because you don't have a massive amount of gamma here, but it is going to play out over time. And like I said, it's going to give you that ability to kind of slow burn it and wait for that thesis to play out over time, which I really, really do think it is going to. So I'm pretty excited. I'm very, very excited about the next 4 or 5 months and over the next year. I think they're going to be amazing, amazing opportunities. Make sure you watch all my videos. Hit that little bell down there so you don't miss any of them, and we shall see you in the next video.